Hello and welcome back to the podcast. I have a very, very special guest today, the man who has shaped and influenced the way that I view not just markets, but also a large part of the world. James Davolos, PM of the INFL ETF and member of the illustrious New York research firm and asset manager Horizon Kinetics, joins me today. We are going to talk all sorts of things. There's lots of things happening. James, thanks for coming back on the show. Welcome back. How are things with you and what's happening over in New York?
Well, thanks for having me, and thanks for the generous introduction there. Things are great. I mean, it's the days of sleepy, quiet summer times in finance, I think, are a vestige of the past. But I think it's a lot of good things to keep us busy, a lot of exciting things, and obviously markets are going to chop around, but we seem to really like kind of where our setup is, kind of longer term still.
Yeah, for sure. And we've got a previous podcast under the belt. So if anyone's watching this for the first time, I'll leave a link in the description and I highly encourage you to go and look at that. It'll give you a great setup for some of the topics that we're going to touch on today. But briefly, how are things at INFL? And for someone who hasn't heard, maybe you give us the elevator pitch in terms of what that ETF is and why it really is different to the other ETFs that someone may be looking at in terms of investing.
Sure, and things are great. We've been annualizing in about 4.5 years since we've launched. So coming up on our 5-year anniversary, around 15% compound annual growth rate, depending on the day. But really happy with that. But I'm really happy with it for a specific reason, which is that we've never had a down year. We've been able to protect the downside in years when the S&P, tech stocks, ACWI, even energy, gold, financials, real assets in general had big drawdowns. And I think that's by virtue of focusing on these capital light real asset businesses that we discussed in the first podcast. And if you think about the way that the world is evolving, where I think more and more people are realizing that central banks, particularly in the US, but worldwide, are going to, quote, run it hot, meaning we need nominal growth because I think we've seen that the Western world and the OECD world doesn't have the metal to go through a Greece type of restructuring or an Argentina type of restructuring where you have to sign up for a decade of negative real GDP growth. Not only would that collapse the financial system, but that would also just be devastating to the populace and politicians that are going to get thrown out of office. And so I think that we've gone through these three separate phases. So you've gone through financial asset inflation. We've had our spike in consumer inflation. Now I think we're going into the third stage, which is going to be real asset or hard asset inflation. Critically, to your point, in INFL, we feel like we own it through the best mousetrap, which are these capital light business models that have a lot of leverage to that nominal growth without having kind of the expense and capex exposure.
Yeah, absolutely. And that philosophy, as I mentioned, did change the way that I look at investing in terms of not having so much downside exposure, but being able to have all the call optionality in terms of rising revenues without commensurate rises in the expense column. Speaking of expense columns, I don't know about you, but my expense column tells me that you were correct when you said that inflation is not transitory. And it seems likely that we have a change in the Fed chair one way or another that is almost certainly going to lead to a dove occupying that Fed chair. How might markets react to that? Or do you think that what we've seen recently is the markets, particularly the gold bond and the Bitcoin market, already pricing that in? Or you think that it's still going to surprise people?
Yeah, I'm glad you brought that up. I think that gold and Bitcoin have sniffed this out, but that is kind of the incremental fund flows. And so if you look at the drivers, it's fairly readily available information. The World Gold Council puts out phenomenal information on a monthly and quarterly basis. And this is central banks. This is big, large institutions and central banks that are driving the buying in the gold and the bullion market. They see what the US and what other OECD countries are doing with their currencies. And I think they're just saying, at the margin, do I want to sign up for just parking more of my money into these government obligations? And the answer is, look, the dollar's not going away, the euro's not going away, the pound's not going away, the Aussie dollar's not going away. But at the margin, a little incremental shift into gold, and you've had this very large move. So that incremental dollar has sniffed it out. I also think more of the younger generation of wealth, they recognize some of the debasement properties. They have sniffed out this financial inflation that was pretty subtle before it really broke out and people kind of the wool was taken over off their eyes during the CPI shock. And they're saying, look, I don't want to be in dollars either. Gold, that's what my grandparents owned. How about this Bitcoin stuff? And so two different leading edge types of investors, but then you've got tens of trillions of dollars of the old guard, Vanguard, BlackRock, Fidelities of the world that have almost no exposure to these things. And so when that shifts, sure, they can put an incremental couple dollars into gold and Bitcoin, but where is the real flow going to go? It's going to have to go into real assets because they need actual companies that generate cash flows that can populate these equity portfolios and provide these asymmetric different types of return profiles. And so maybe I'm being optimistic or talking my own book, but I think that gold and Bitcoin are telling you where Wall Street is going. Just they might be front running it by anywhere from 6 months to 36 months.
Yeah, it's so interesting. I talked to Joe Cavatoni, the head of the World Gold Council, last week. And as you rightly mentioned, it's everything that we've seen, as impressive as the gold price has been over the last 12, 18 months, it's still only central banks. We're still yet to see retail and we're still yet to see institutional capital allocate more than, let's say, half of a percent back to that longer term mean of, say, 2.5 to 3%. I've got a hat here that says "Make Gold Great Again." I picked it up from last week. Are we going to make gold great again, James? Do you think there's a lot of talk around, 50-year gold-backed treasuries and all this sort of stuff? How do you see it? Do you see it as a lot of noise, or do you think that no, actually, this is the start of a fundamental regime shift in terms of a monetary reset?
In my mind, gold's always been great, but I think it's been obscured by higher beta and higher octane stocks and speculative assets that have really been supercharged by accommodative monetary and fiscal policy. And you've had this huge re-rating of financial assets. Again, go back to when Greenspan took over the Fed in the late 80s. 10-year peaked shortly before when Volcker, basically broke the back of inflation. Ever since then, you've had a declining 10-year until the Powell started hiking rates. But that was basically supercharging financial assets coupled with higher and higher fiscal. So we went from crisis fiscal spending in, let's go back to 9/11, 3-4% deficits, and then global financial crisis, 10/11, COVID, 14-16. Now an expansionary deficit is 6-7%, which is $2 trillion a year. That has all supercharged financial assets because in this wish wash of liquidity, it goes to where it's easiest to accommodate that dollar. I think smarter people, and intuitively, it's been central banks at the margin, are recognizing maybe that's playing itself out. I think there's a lot of hamstrung assets in private markets that still have completely ludicrous marks. The leading edges in gold. So I think the fact that gold has dramatically broken out relative to its long-term trend, relative to the real 10-year treasury yield, so 10-year minus inflation break evens. You could look at 1, 3, 5, 10-year swaps, whatever you want. That was correlated, almost overlay those charts, you couldn't tell a difference. And also the DXY, the US dollar index, overlay those charts, you couldn't tell the difference. Gold materially broke out from both of those correlations, I want to say 18, 24 months ago. And to me, that's a sign, okay, the financial players are no longer in charge. The people that are trading gold based off of those algos, those are the quants who are basically trying to get, 10 cents here, 20 cents there on basically taking this stat arb. When it breaks out, now the physical is in control of the ship. And that to me is a sign of regime change. So yes, I think we are in a completely new paradigm for gold and difficult to really handicap what the upside is under a variety of scenarios where, sorry, one more macro comment. If you look at Scott Bessent, he made a very telling comment the other day on CNN State of the Union where he said, the idea here is not to reduce the deficit, it is to keep debt to GDP static. So again, what does that mean? That means we can continue running 6 to 7% deficits as long as we grow nominal GDP at 6 to 7. Almost impossible to grow the US economy sustainably over 3%. That means the plug for inflation is 3 to 4. So anybody with a high school level of understanding of math and economics basically can do that math on something that the Secretary of the Treasury has explicitly said. And so again, that points to gold, Bitcoin, real assets, etc.
Okay. Moving on from just the monetary policy and the monetary debasement aspect of inflation, you touched on some of the other structural drivers that you think are going to start to manifest themselves in hard assets. What are some of those structural drivers? And do you include economic policies such as all the noise we've heard around tariffs? What's something that's not monetary based that is certainly going to contribute to inflation moving forward?
So there's definitely an aspect of scarcity. And so why are people buying gold and Bitcoin? Because there is theoretically a component of finite scarcity in both of those assets. And so when you look at certain types of real assets, and this doesn't necessarily relate to every real asset, there is this scarcity. And so if you have scarcity, with things like land, with things like infrastructure, with certain types of resources, that lends to pricing power and volumetric increases to where there's a much higher leverage to nominal growth in those assets. I would add that there's been underinvestment in a lot of these sectors, which you can go back to malinvestment leading up to the global financial crisis. But so ultimately, it's going to be figuring out the real assets that have this idiosyncratic scarcity, but then also that are in the correct business model so that you're insulated to some extent from the OPEX and the CAPEX that erodes a lot of returns in traditional financialized real assets.
Yeah, for sure. And forgive me for being reductionist, but a lot of what you guys are focusing on comes down to land and its associated water rights, energy, and then a technological aspect. Talk to me a little bit about how you express the call option on the demand, particularly around the energy. Let's do energy first. And then how, as you touched on, finding the right business model that's not going to try and bet on the right horse necessarily, but is going to express the theme via winner agnostic fee collectors.
So I think you need to really break it down into two components there. So let's focus on energy, and here we'll focus on traditional hydrocarbons, one being gas, one being liquids, primarily oil. Very distinct demand drivers for both, but I think that the world has overestimated the green transition, and it's not a function of ideology or a lack of climate awareness. I think you need to remove that and the emotional attachment to that from the conversation. Real drivers going to be growth in energy demand henceforth will not be driven by the OECD world, so the developed G7 plus. It's going to be all emerging markets, and they need reliable and inexpensive fuel sources. That right now is not possible with most renewables. And so you're seeing a very strong demand from the likes of India, Indonesia, ASEAN countries, China, et al. And we haven't even talked about Africa yet. And so one of the most compelling arguments I've heard about the long-term demand profile for oil or liquids is you look at the billions of people in the world and their GDP per capita. And if it were just to rise to what is considered impoverished in the West, you're talking massive changes in long-term structural energy demand. And so what's going to drive that? It's mostly going to be transportation, so road transport, aviation, but then there's a huge pet chem business where you're using petroleum for plastics and other petroleum products and chemicals that are in our everyday lives. So because of the ideology around renewables, and also because of this thought that we were at peak oil and that shale was going to basically imbalance the market forever, we think that it's not here today, but could it be here in 6, 12, 24 months? I think the world's going to realize that there's a much longer tail in oil demand that the world has not invested for. OPEC is screaming it from the mountaintops. They just had one of their summits this past week, and they think by 2050, global demand is going to be around 120, 125 million barrels versus 103-ish today. Most global experts think that, that's we're going to be below today's levels. I think so. Anyway, that's one side. Gas is also incredibly interesting because gas for a while was just thought of as this really abundant, cheap, almost worthless byproduct of oil wells. Primary use of this methane gas with dry gas in the US is for power generation. US gas has traded at huge discounts to global benchmarks because the US produces more than we consume. And up until very recently, we were subject to a very unique injection versus withdrawal season dynamic because we don't have enough storage in the United States net of exports, such that if we have a very mild winter, or a summer where you're not withdrawing a lot of gas, you can actually run out of storage capacity. And so you've seen over the past years, if one train of an LNG, a liquefied natural gas export terminal, goes down, the gas market collapses. Well, now we're doubling LNG export in the U.S., while in the background you have this massive power renaissance around powering AI, where in some cases, you might be talking 20, 30, even 50 gigawatts of incremental demand around AI and its ecosystem. Just for context, New York City draws about 5 gigawatts. So that's a factor of 10x of New York City. And a lot of that's going to have to come from combined cycle gas, because imagine you have a $50 billion data center. You probably don't want that having extended downtime because it's not sunny or windy. So long story short, we think that there's a lot of secular demand around both of those molecules that the world does not appreciate and has not invested for and is not priced in. One of the problems, though, is that put yourself in the seat of a CEO of a company that produces these molecules. Historically, you've been tasked with producing as much as you can at the most economic rate, but then also replacing those reserves and ideally growing reserves in production. So in a world of a upwardly sloping demand curve, but also an upwardly sloping cost curve, you're investing pro-cyclically. So unless you think that this cycle has forever been tamed and prices will just kind of have this nice, steady, smooth upward migration indefinitely, your investing pro-cyclically is going to dilute your existing returns. And then when the cycle rolls over, you're probably going to have some marginally or uneconomic capacity. And so we try to control for that by owning the most efficient business model to express that view, whether it's land, royalties, water transportation, water royalties, et cetera. And so it removes some of that beta and that pro-cyclical exposure to OpEx and CapEx.
And the beauty of those business models is they can oftentimes, at least in the precious metals side of things, the royalties and streamers have the most advantageous set of circumstances to be able to invest counter-cyclically during soft or bear markets. I had a few comments. One, I jokingly refer to the IEA energy demand estimates as like the annual revision, because they always put it out and then they always annually revise upwards. It's like a miracle. And let's touch on water, because no matter which source you use in terms of hydrocarbons, it's all like steam turbine generated, the power, right? So the bottleneck truly, if you really dig into it, as you guys have done, is realizing that the true bottleneck is water. Talk to me about this kind of paradox that the stock indexes are highly dependent on the IT sector. The IT sector, in turn, is critically dependent on land and energy and, in turn, water. But yet the indexes really have almost zero meaningful exposure to water. It seems to be incredible to be looking at that today.
Yeah, it's a great point. It's a really difficult asset to get pure exposure to. So very large, very well-run water funds and water infrastructure funds with public equities, they generally own regulated utilities, which are not all that different from power utilities, where there's a government contracted return on equity. Then you'll have companies that are industrial components, whether it's pipes or filters or pumps, and those companies are going to do fine, notwithstanding valuation metrics. But to actually get directional exposure to the pricing and availability of water in some of these regions is basically non-existent in, let's call it, industrial scale investing, which is how 90+% of dollars are allocated today. I'll just give an example. So in the US, if you were to just Google any of these hyperscale data centers, so right now, the concentration of data centers are in Northern Virginia and then Santa Clara, Northern California, kind of near San Francisco. And the reason is that there's proximity to the end clients, and thus far, they've been able to procure enough electricity and water. When you hear about, and these are mostly edge and cloud data centers. So you're talking 50, 100. I mean, a huge data center would be 200 megawatts. So when you start talking about a gigawatt, 2 gigawatts, 3 gigawatts, which is what some of these hyperscalers are saying they're going to need just for this first iteration of AI development, you need thousands of acres, billions of gallons of water, and massive combined cycle gas plants, which you just can't plug into the grid. The co-location queues just can never get filled through the traditional utilities nor the independent power producers. And so, if you look at these communities, there's a recent article about a community in Alabama. There was another one in Pennsylvania, and these communities are outraged because they don't want to compete and pay more for water. They don't want to pay more for electricity. They're loud, they're ugly, and they don't really produce that many long-term jobs. Like, sure, there's a big boost to build the thing, but you need a couple of fairly highly trained engineers to basically keep the thing running. And so, what does that mean? I think it needs to go to areas that are remote, areas with an abundance of gas to power the turbines, unregulated power grids, and water. But just to answer your question more directly, one of the limiting factors in this whole equation is even though these gas plants, I mean, nuclear is a little bit different, but nuclear needs water as well, although I don't think you're going to see a large scale nuclear facility built in the US anytime soon, given the debacle of decades and tens of billions of dollars of cost overruns the last time we built one in Georgia. But so let's focus on gas. Yes, basically, you're heating up the steam, as you mentioned. You can recapture some of it, but it's impossible to recapture all of that. So you need a fairly large and consistent supply of water to basically run those combined cycle turbines. And people talk about these closed loop systems, but I think that kind of ignores the laws of physics where you're heating something and there's a loss of some of the vapors, which is used to push these steam turbines. But then there's also a large water requirement to cool the data centers because you can't cool, thousands of these GPUs through traditional HVAC. It just would be cost prohibitive, and you want to talk about how much gas you would burn to actually power those HVAC systems. And so what they use is liquid circulation or forced water. That needs very pure water, but again, there's two big deltas around water demand, and most of the US is fairly arid and prone to droughts. And we're trying to isolate different businesses where they have optionality around that water. I think it's interesting just in and of its own right because of higher water scarcity related to population and agriculture. What people don't really realize is the big draw on ag water, which is the biggest demand suck of water. It's for crops, but those crops are to feed animals, to feed people. And obviously that needs precedent. And so then the industrial demand is kind of you have municipal, you have farming, and then industrial. And so this industrial buyer has probably the highest ability to pay up for that water because of kind of their end use and then kind of also the least amount of political support. And so if you're in a situation where you can provide water, beneficial reuse in this case in the energy industry, to farmers, to different agricultural regions, and then also have this optionality around industrial water, we think it provides a really interesting asymmetric investment scenario.
Indeed, it does. And you mentioned that you have some businesses that are of interest to you in terms of expressing this theme. I want to hold that thought for one moment because what I've been thinking a lot about recently is this idea of an equity yield curve. And sometimes it can be a bit tricky because people, A, don't look out far enough to see earnings into 2 years, 3 years, and B, their sources of earnings may not have materialized yet, say a water company increasing its volumes and that sort of thing. Would you mind educating us on this idea of the equity yield curve? And then perhaps we can tie that into the concept of the businesses that you're interested in investing through the water and energy theme.
Sure. And obviously, I need to give credit to the investment team at Horizon, Murray Stahl, our CIO, for formalizing the concept. I can't take credit for it. But think about the idea of a bond with a yield curve. In a normalized environment, there's an upward sloping yield curve as you're taking greater uncertainty and greater interest rate risk as you go further out. So before these bizarre times that we live in, there was a pretty normal upwardly sloping yield curve between 1, 2, 3, 5, 7, 10, 30 year maturities. A similar concept exists in equity, although it's less quantifiable in the sense that most investors are investing around a finite calendar year where they need a catalyst. So they want, hey, most hedge funds in particular are saying, hey, are these estimates too high or too low? Where's the catalyst? Is there an M&A? Is there some sort of an arbitrage? If you're telling me the stock's going to triple at some indeterminate period over the next 5 years, they don't care because they don't get paid. They might be out of their seat by then. So Murray has formalized a concept where it's let's identify something where we have a pretty high confidence interval that there's a very material catalyst. We just can't really tell you when it's going to happen within 1, 3, 5, 7 years. But the greater the uncertainty of that catalyst, the higher the discount rate. And so by virtue of underwriting something indeterminate in the future, you get a higher risk premium, again, to go back to the bond yield curve. And so an idea that's something that's popular today, I mentioned before, the independent power producer, so the unregulated utilities. A lot of those are up 5, 10, even 20x from a couple of years ago around this notion that there's all of these co-location agreements right around the corner. So you look at who owns these, it's all of the huge pod shop momentum hedge funds, because that's their business. But then if you look at maybe these similarly asymmetric opportunities that we've been talking about, but you don't know when that earnings revision is coming, nobody even cares.
Yeah, very nice. Is there a way, would you mind sharing some of the businesses that you think might illustrate or represent that opportunity today?
Sure. I mean, one that we've talked about together, and I'll parlay this into a couple of other adjacencies that I think we've also touched on, but we've been invested in Texas Pacific Land Corp as a firm for decades. And one of the benefits of them having close to 1 million surface acres in the Texas oil fields is that they not only own the source water, which is basically a brine water that can be used in fracking oil and gas wells, but they also provide a vital role in handling produced water, which is the water that comes out of the formation with the oil and gas. And so in many areas, this formation water, it's a liability because you have such a high saline content. There's a slurry of inorganic material, acids, different types of hydrocarbons, bacteria, such that it's not viable to be reused in oil and gas fracking, let alone agriculture or anything. So as of right now, most of that is being transported and disposed of in saltwater wells. And TPL earns a royalty on third parties basically providing that infrastructure and then the saltwater disposal well. But this is critical, and not enough people, everybody seems to think that US shale is going to provide this stabilizing factor in global oil demand. But water cuts, meaning the amount of water per barrel of oil, are going up dramatically. And so a lot of this has to do with production moving to the Delaware Basin, which is where TPL is concentrated, where you in most of the basin, you're getting about 4 barrels of water for every barrel of oil. So think about that for a minute. You need literally 4 times the infrastructure for water that you do for oil and gas. And think about the hundreds of billions of dollars of oil infrastructure, even before accounting for gas. However, that number is actually going up because as you go deeper, there's more pressure and there's actually more water. Where at the lowest benches, they would call it the lowest shale formation, you could have well north of 10 barrels. So in some parts of the basin, you're paying over $1 a barrel for disposal of this water. And so think about $60 oil. A lot of that barrel is also gas, which right now at $3, $4 has an equivalency of $18 to $24. If you're paying $6 of lease operating expense just for that water, it's massive, and it's actually going to be a limiting factor in the industry. We can talk about a lot more of kind of some of the issues with seismicity and different regulations. But so by learning about that business, we were introduced to LandBridge, which came public almost exactly a year ago. They run a similar land business to TPL's Surface, where it's effectively a triple net lease on their water business, which is WaterBridge, which basically operates a disposal well network. During their IPO, and then from speaking with them over the last year, we've learned much more about water. But again, if you think about the billions and billions of gallons of water, or in this case, tens of millions of barrels of this produced water a day, base case, you're earning a phenomenal return simply on the volume and pricing of transporting and disposing that water. But then the optionality comes in with beneficial reuse. So beneficial reuse is, can they clean this up through different types of desalination, separation technologies? I think it's very easy to see where that could be viable for agriculture and different municipal uses. The next step is, can it get clean enough? And it seems as though there is a path to get there. The question is at scale and price to then use it for industrial uses, whether it's power or cooling. And so if you think about it, you're underwriting a phenomenal business that's growing with margin. I think it actually is much more of a waste-like business, which trade at many times the multiples of oil and gas infrastructure, with this really long open-ended call option around beneficial reuse of this water. By the way, this business is critical to balancing global energy markets, and nobody's ever heard of it.
Yeah, it's incredible, especially when we see Scott Bessent talking about the three plan, the 3% growth, the 3% deficit, and then 3 million barrels of oil a day. Well, if you're going to get to that increased production of 3 million, as you said, you got to multiply it by the amount of associated produced water barrels because they're an inherent product along with the oil. One thing that caught my eye was the takeover of Viper of Sitio Royalties. And if I read correctly, the pro forma company will be roughly 17 billion, somewhere in that vicinity, which puts it pretty close to TPL. And yet no one seems to be talking about it. Has that surprised you? How did you see that transaction?
Yeah, it's not surprising to me at all. I mean, Viper is just phenomenal assets. I mean, it's basically only oil and gas royalties, which the market just hasn't figured out. Maybe you could argue the Canadians understand it because Prairie Sky, I think, trades at still a huge discount, but a more realistic manifestation of fair value. But so just to rewind a little bit, Viper was always a subsidiary of Diamondback. Diamondback is a very well run, great oil and gas shale driller. And so the knock on them used to be, okay, you're a subsidiary of Diamondback and you're just here to basically offtake their minerals and you're not being run for the shareholders of Viper. I think that was wrong, but I'm only one participant in the market. It was a limited partnership, so nobody wanted K1s. They convert out of a limited partnership. Lo and behold, you're still an LP in name, even though you're taxable, you still can't go into the indices. So earlier this year, late last year, they finally convert into a C Corp. So now you're available to be in indices and you start getting a few eyeballs. But Viper basically just blocking and tackling, adding great acreage, doing it accretively. Basically, they have a sponsor in the form of Diamondback just dropping down royalties to them. And so it's a great business, and I'm still shocked that more people don't appreciate it. Where if people want to take incremental hydrocarbon exposure, why wouldn't you own this? Where you can own it on and off at easily double-digit free cash flow yields at $65, $70 oil, $3 gas. One of the big things in investing worldwide, but particularly in these names, has been liquidity and scale, and so Sitio was a merger. It used to be, well, if you go all the way back, it was Falcon, which was actually a SPAC. And then a company, Kimmeridge, merged their portfolio into it. And so you had this huge private equity overhang, a multi-basin mineral portfolio, a couple $1 billion. And it was then they merged with Brigham. So Brigham, also one of the best mineral teams in the world, backed by Bud Brigham, who's a legend in oil and gas and energy investing. And so I think Kimmeridge had these designs on just blocking and tackling and building this piece by piece, but eventually they realized this is just a really long slog. And unfortunately, like every other PE sponsor, they don't have evergreen capital where they can wait forever. And so I think they realized it was in everybody's best interest just to merge that into Viper. Now Viper has a lot of scale into some phenomenal assets. They're not 100% Permian, but I think that added scale. And now I think Viper is going to be the natural consolidator of minerals. And I think that they should earn a higher and higher multiple. I mean, particularly as you start seeing maybe a better environment for oil and gas. But it's a very different animal from a land bridge or a TPL, where a lot of their value is in the surface, is in the water, and is in these kind of non-oil and gas related revenues. And I think that's why the multiples diverge.
Yeah, I'm shocked as well, which is why I actually skipped ahead when I meant to ask you about Aris Water, which would be kind of, it seems to be a very specialist company, really only focusing on the water infrastructure. How do you see Aris evolving to solve this problem of produced water in Texas? And what are the drivers for its growth in terms of really hitting scale?
Yeah, that's really great questions. But so I think if you were to rewind a little bit and talk about this produced water, so historically, this has been a liability where if you're Conoco, your Chevron, your Diamondback, or even some of the smaller independents and juniors, this is a liability, and your job is to just basically manage this liability. Most of the water in the US and the Permian is managed in house by their teams. But more recently, you've seen issues around seismicity. So you're injecting the water into very deep formations below oil and gas. Water's heavy, it gets into fissures, and you have these tremors and small earthquakes. So regulation around seismicity. So now they start injecting it shallow. And shallow, the thing that people don't realize is the Permian's been drilled since the 70s, even before that, but really it peaked in the 70s. And so you have all of these 50-year-old wells. And if you're drilling shallow, it can get into these well bores that were not capped properly. And you can allow a lot of kind of nasty stuff to flow, and in some cases, flow into the surface and get sinkholes. So now you're having more and more regulation, both in New Mexico and more recently Texas, around permits for injection, such that because of the combination of cost and this concept of limited pore space, so the porosity of the rock, theoretically there's a ton of pore space, but it's a factor of timing. So if you think about, you pour water into the sand, it's going to absorb. But if you pour, I mean, you pour a bottle of water, but if you pour a huge bucket, it's going to well up because it can't absorb it quickly enough. So that's basically the concept of porosity, where you're putting too much water too quickly into too concentrated of an area. So what does all this mean? It means you have to basically, the existing injection permits are worth much more because it's going to be much harder to get new permits, but then you're going to have to transport it out of basin. So this is important for many reasons. One, because it's going to increase the lease operating expense of incumbents. So now this is mission critical. It's gone from the marketing and gathering team. Now you're going up to the C-suite where COO, CEOs are talking about water. And even the majors, so your Chevron and Exxons of the world, are saying, hey, Eris, hey, Waterbridge, help me deal with this liability. In some cases, I might need to transport this water 50, 100, 200 miles, get it out of the basin and put it to where you have injection wells. So go back to your original question. This is a mission critical problem for the entire world in terms of balancing the energy market when you think how important the Permian is. But you can no longer just take your water at Chevron and say, hey, let's call up the neighborhood rancher and just put the water on his land. We'll give him a couple of bucks. Now they're actually calling up the water bridges and the Arises of the world, and they're saying, look, I need a solution for a decade, and I will pay you to make this problem go away. So go back to the investment case. These things are trading below 10 times EBITDA when they're running well below capacity. And I think there's a lot of room for pricing and volume, but then also inorganic growth as they have these contracted take or pay pipelines and disposal for a growing pie. So again, go back to my waste analogy. You look at the multiples assigned to things like Waste Connections and GFL and all of these businesses that are triple or quadruple what you're getting in Permian. Even Clean Harbor and industrial waste is more than double. In some cases, these are 30-year revenue streams. That's a necessity, a contracted revenue, and then that back end optionality of beneficial reuse. So Eris is in a really good spot. The one limiting factor that they have is that they don't own the land the way that Waterbridge has land via Waterbridge via Landbridge.
Super interesting. So we've got an inelastic source of demand that's rapidly growing. These companies have their own respective competitive moats. They've got optionality on the volume and the pricing of the throughputs. How is their infrastructure is largely built? Is there any extra capex that you see? Any major capex they would need in terms of hitting that extra volume in the near term?
Well, last I looked at the numbers, and WaterBridge isn't public yet. They don't have an S1 filed, so I don't have good numbers on that. With Eris, last I looked, if you combine their produced water handling, which is just taking that brackish and then either putting it into one of their desal or recycling plants or injecting it, combined with their water solutions, which is the basically the beneficial or the recycling, they were running at about 60% capacity. So there's a lot of room to just fill that up. But I think increasingly when you see a new operator come in and they want to bring a big well pad in simulfrac where they're doing a lot of wells at once, they got to figure out this water before they even think about drilling. They might say, look, guarantee me that you can handle X million barrels a day, 100,000 barrels a day for me. And it's almost like a taker case. It's almost like a pre-funded contract with a customer, and that de-risks it, similar to what Cheniere does. So Cheniere, they won't build any LNG export until they have a 30-year take-or-pay contract with a single A or better counterparty. I think that's how the business is evolving, and that's going to add to price, volume, and de-risking to where I think you can migrate towards that waste multiple.
Yeah, absolutely. There was the other engine that the other lever I forgot to mention was a multiple expansion there. So certainly a lot of optimism for the future case. One thing you mentioned last time we spoke, I asked you one of those annoying questions, where people say, if you could only have one metric to use, blah, blah, blah. And the reality is you have lots of metrics you can look at. But you mentioned to me that ROIC, return on invested capital, is a metric that takes precedent in your mind when looking at a business or an investment case. And I'm reminded of the quote of Charlie Munger when he talks about if you can find a business that consistently earns, call it 18, 19, 20% return on capital, even if you pay what looks like an expensive price at the time, over the long term, it's going to work out really well. Is there a business you own currently, it can be one you've already mentioned, that you think is a generational compounder, but the market misunderstands?
I mean, I think land. So again, the land portfolios with Texas Pacific and Landbridge, it's just you look the returns on invested capital, just you can't even calculate them because a lot of this was basically sunk capital or something that they paid very little for and monetized it. I think some other great examples that are underappreciated, I mean, you could argue that they have reasonable multiples, but they're at a huge discount to the SaaS and software and kind of the zeitgeist names. But I don't know if we've talked about global exchanges, but you think about in the US, you have Intercontinental Exchange, CME, CBOE, globally, Deutsche Börse, LSEG, ASX, et cetera. These businesses have margins and returns that are just absolutely exceptional. And something that gets lost on the screening community, which I say with obvious somewhat of a pejorative connotation, is that you just run it through your financial metrics, and these companies have clearinghouses. So you pull up CME and you don't do your due diligence. It's like, oh my gosh, they've got hundreds of billions of dollars of liabilities. Like, what are these guys doing? It's like, well, it's matched penny for penny with client capital on the asset side because of this clearinghouse, which basically guarantees if you sell me a call option that I can't just go run away to, the Maldives and not pay you. So that looks like there's all this capital intensity that's matched. But if you actually run the numbers correctly, these exchanges are just unbelievable returning businesses. But the clearinghouses provide a moat around competition because you can't clear a derivatives contract the way you need. It's a captive clearinghouse. So the contracts are very specific. You could buy Google at one venue, sell it somewhere else. You can't buy a SOFR future on one venue and then settle it and sell it somewhere else. But if you look at the revenue growth, the margin, and the returns on invested capital, exchanges are just such a phenomenal business model. And then you look at things like credit card processors and software and these other companies that constantly have to reinvent themselves that have pretty big multiple premiums to these businesses that are effectively regulated monopolies, just growing at above nominal GDP with margin.
What's your biggest cause of concern over the next 5 to 10 years? And in juxtaposition, what's your biggest source of optimism?
So I think I'll kind of maybe answer it as one and the same. So one of my biggest concerns, and sitting here in New York City, where I think you have a pretty international audience, but there's a very radical mayor who appears to be slated to win the New York City mayor race in the fall, and a lot of the policies are socialist. And take my politics aside, I think that it's a manifestation of the youth in the country being disenfranchised because they can't afford homes. They feel as though they can't even afford they can't afford basic things that their parents and their grandparents, if they just worked hard, they were able to basically achieve. And the juxtaposition to that is all of the luxury and benefits that we have by global and historical standards between our availability of heating, cooling, available water, available food, these supercomputers in our pockets, healthcare, safety. But I think it shows you that there is a largely disenfranchised part of the world and part of the populace. And so go back to my comments when we started about this financial asset inflation, shifting to consumer inflation, now shifting to hard asset. Historically, when all of this wealth concentrates at the top. And if we run it hot, it's just going to get more and more concentrated at the top. And I don't know what that means for society. And then particularly, I have no idea, and I'm not going to speculate, but if AI does marginalize the lowly skilled labor or even kind of eliminates or rationalizes some of these entry level jobs, that's only going to make this problem worse. So I do worry about that because on the one hand, I have so much confidence that this is the end game and this is where we want to be. What are the second and third derivatives of a kind of debasement, fiscal dominated world? And I think it's going to be more and more of the populace being disenfranchised. But so then on the flip side, it's so easy to be negative and it's so easy to look at the glass half empty, but then let's also look at the glass half full and look at all that we've achieved as a world. And so amongst all of the strife and the negativity and the conflict, the world pulled itself out of this pandemic conflict. We're evolving technologies, we're evolving as a society. And so particularly as an American, I take a lot of pride in that and the ability of the American people to constantly innovate and to constantly develop a strong economy and a strong society. I think out of the tumult often comes opportunity. And so sometimes you need that spark to create that next wave. And I don't know what that's going to look like, but I think that maybe this will be a catalyst for certain things to develop where there's a right tail that we haven't really forecast yet.
Yeah, and I think that looking through the holdings in INFL and everything that you guys are writing about from a research perspective seems to be an intelligent way to position oneself to protect from some of that downside and to participate in all the optimism or the sources for optimism that you mentioned. Last question, and then I'll cede the floor to you for any final comments. What's a book that significantly shaped your view of markets or the world? You probably got lots, but is there a particular book that comes to mind when I ask that question?
Yeah, I was actually just we have a couple of interns that work with us, and they were asking, and so I try to give something practical that's actually useful. And I'm sure you've seen it. There's a lot of PDF. I'm not getting in trouble for saying this, but there's a lot of PDF copies going around because original print versions of this book are several $1,000s. But Seth Klarman of Baupost wrote Margin of Safety. And it's just such a thoughtful book on just how to think about investing and how to think about managing your risk. It's really timeless, and I'm sure you've heard the story, but the anecdote that I love is about the trading sardines, where these traders were trading these sardines, and there was almost like this feverish frenzy where you couldn't get your hands on sardines, and so the prices were going up and up and up and up, and then one guy finally made so much money trading sardines, and then he opens up the can to eat them because he felt rich and entitled that he could finally eat his sardines. And they were rotten and made him sick. And he's like, oh my God, I can't believe people are paying for these. And then another trader said, no, those aren't eating sardines. Those are trading sardines. And I think that that is just so apropos of the market today. I just think that that book is really exceptional. Another one, which I think is also timeless, with his recent passing, Charlie Munger with Poor Charlie's Almanac. I always had this huge voluminous copy that was like an encyclopedia on my desk, and it was really annoying to read. But now there's a new one in print that's more of kind of a novel where you can kind of just read through, and it's short sections, so you can just tackle a little bit at a time. And you know, the reason that I like those books is they don't get into the academics of saying, okay, this is how you do a DCF, this is how you do an LBO model, this is how you do a capital structure optimization or like an option straddle. It talks philosophically about how to think about the world, and particularly with all the beta strategies and passive strategies, I think people need to learn how to think and then how to apply that pragmatically to investing. And that's why I really love both of those books from just two generational thinkers.
Yeah, great recommendations. It's pretty hard to get that one of Klarman's. I've seen a few copies floating around on eBay, but yeah, they want a few pennies for it, that's for sure. Where can people learn more about INFL, the ETF, and learn more about you and the firm at Horizon Kinetics?
Sure. I think our website is a great place to start. We publish a decent amount of our research. Steve Bregman writes a great quarterly commentary. I write an annual and semi-annual letter for INFL. So just horizonkinetics.com. There's a products landing page where you can drill down into INFL, and there's plenty of resources. And then we have a great client service and business development team where if you have any other questions, there's contact info for them and they'll get right back to you.
Yeah, absolutely. Link will be in the description. Speaking of questions, is there anything I missed? Is there a question you think I should have asked you today that I did not?
Now, you really touched on a lot of things that I wanted to talk about. I think I just really can't emphasize enough that the world kind of goes through these structural regime changes. And if you look at all of the contributing factors that have benefited, quote, the large tech and the beta trade, going back to, again, when Volcker seeded the Fed chair, I don't want to get overly macro with monetary policy. It's been almost a perfect environment for 40 years of compounding in large growth equities. And the way that finance has been structured with a very heavy academic lens, we just look in the rearview mirror and say, sure, equities are going to continue doing like 6, 7% real. But then if you look going forward, look at the multiples, look at growth, look at demographics, it's just really difficult to see how broad-based equities can give you that. And so I just can't stress enough, especially for people that are either in retirement and they need diversification to where they can mitigate some of these risks. I think you need to stay invested because I think sitting in cash, sitting in fixed coupon, you're just going to get debased. But then also younger people that are in wealth accumulation mode, you really need to try to find these idiosyncratic assets and businesses that are outside of the system. Even if you want to have 70, 80, 90% in this cheap beta, we don't think that you're going to get the returns that the world has been promised through beta and privates. And, hopefully we've found something that can get that.
Absolutely. James Davolos, man who changed my perception on business models and markets. Guys, thank you for joining us, and I look forward to catching up with you in another episode shortly. Take care.